Hi, good afternoon. Welcome to the marketplace. Coming up, mandatory local cargo insurance for commercial imports takes effect amid business pushback. Also coming up, Treasury bill demand firm as policy rate cuts drive sharp yield compression. My name is Darryl Kwao. Details coming up. And thanks for staying with us, everyone. Beginning today, all commercial imports entering the country must be insured by a local insurance company. This follows a strict enforcement of the mandatory local cargo insurance policy. More details in the following report.
The effective date for this policy, which came from the Ministry of Finance, was February 1, 2026, that is over the weekend. However, enforcement is from today. The ministry has already directed the Bank of Ghana and the Ghana Revenue Authority to strictly enforce this directive. The Ministry of Finance has argued that the move is in line with government's commitment to strengthen domestic insurance market and retain insurance premiums locally to strengthen Ghana's economy. However, some businesses, like members of the Ghana United Association, have strongly kicked against this policy. It is not clear for now whether the government may later take some steps to review aspects of this policy in the coming days.
And as you heard from the report, some business groupings are kicking against this policy. I'm joined by Chairman of the Food and Beverages Association, John Awini, to hear his thoughts. Good afternoon to you. So how is the mandatory local cargo insurance policy affecting the cost of importing food and beverage products for your members? You're muted.
Good afternoon, and thank you very much for your good question. Good afternoon to your viewers. On the surface, I would say that this policy looks good for the economy and to strengthen the insurance sector in Ghana. But technically, it's going to be a very difficult thing to work with. And it is required that the finance minister call this thing back, let them suspend it, and engage stakeholders so that they will be able to understand the technicalities of enforcing and implementing this particular directive. The key reason why we are asking that the finance minister should hold back and engage us is that about 90% of the goods that come into Ghana are on suppliers' credit, particularly members of the food and beverage sector. Most of these goods that come to the country are on suppliers' credit, and suppliers will not allow you, the local person, to determine where you go and get this thing insured. Because the goods, even though the goods are coming to the jurisdiction of Ghana, the goods technically belongs to the supplier. So the supplier has a very strong interest in how you handle these goods, how you insure them, how you store them, and how these goods are just generally handled locally. The goods are paid off as and when you sell basis. When you sell it, every week you will be required to pay the supplier. Every 2 weeks, some of them they have 1 month supplier's credit, 2 months or 3 months, and thereabout. So that's why most of the times when you have the currency fluctuate, we begin to cry, importers begin to cry that, and they are establishing exchange rate losses because the goods are supposed to be paid back weekly or bi-weekly. So when the Minister of Finance comes out like this and gives such a directive, I think that directive can only be applicable to goods that are manufactured locally. But goods that are imported from wherever they are imported from, it is not within the domain of the importer to determine where he has to insure the goods, because the goods are combined ownership of the person the importer and the supplier, and are largely owned by the supplier. So you cannot determine that you go and insure it with a particular insurance company, and then when you suffer losses, and then you now begin to give stories here and there. The local insurers are not very familiar with the importers, or let me say the suppliers. So you cannot go, if you take up a local importer, say, I want to insure with this insurance company or the other. The supplier needs to approve that. It's not within the domain of the Ministry of Finance to determine that. Let us do it. Much as we would like to do that to strengthen our economy, technically it's going to be a very, very, very challenging thing. And I would think that and advise that, humbly, respectfully, the finance minister should hold this thing back and let us sit down and then talk about this, because I don't think we were not even engaged, we were not talked with. And then this just comes in burn. You want to boost some people's business, so to say, insurance business. What about the economy? What about the goods and all that? If the suppliers say they will not supply, what happens? Which goods are you going to use to insure locally? So I would say that let us begin with the local manufacturers. Goods that are manufactured locally, definitely, even though they will owe raw material to suppliers, they are manufactured locally, so they can be insured locally. But goods where a supplier trusts, believes in your integrity, and hands them over to you, and says that I am insuring these goods with this particular insurance group or another, you cannot come out to say that, yeah, no, my government says this.
Right.
This and Ghana, our imports globally is very small, so we cannot begin to determine what happens in the global market.
You talk about what impact this would have on the economy. We know that most of the businesses under FABAC are small and medium-sized enterprises. So talk to us about how this policy could affect their ability to be competitive, and also what operational logistical challenges this may bring about.
I'm saying it could lead to shortage of goods in the country. It could lead, generally, depending on the cost of goods, generally depending on the performance or the insurance interest rate of the insurers, the local insurers, it could impact negatively on the cost of the goods in the country. So generally, it is you need to insure the goods with the person that you trust. If the local insurers, their rates are good and they also have a good standing, then businesses may be able to convince their suppliers that, one, let us insure. In any case, we are here with them. So it may be much more easier to insure with them than to go and insure in other jurisdictions. But it is not within the domain of the importer, let me emphasize, to determine where these goods have to be insured. It is the domain of the supplier who owns the goods. Somebody cannot give you millions of dollars of worth of goods, and you come and say that I'm insuring these goods with this particular person. Remember, when you go and buy a car based on bank loan, and it is the company that funds the purchase of the vehicle, you cannot take that vehicle and go and insure in the company where you want. It is the bank that has given you the loan that determines where that vehicle is supposed to be insured. And the documents are largely being kept by the bank. Until you finish paying, you cannot claim ownership of the goods. It's the same way that happens in the international market with the goods that are coming to the country. The goods are given out on credit. The money belongs to the supplier. So you cannot unilaterally, based on the directive of your government, and say that you are going to insurance company A or the other. It could lead to serious negative impact on in the country.
Yeah.
And that's why we are saying that I don't know whether the finance minister averred his mind to this particular or not. If he had had good meetings with us or had meetings, we would have raised this one up that yes, we are in this country. It is our responsibility to help build this country. It is our responsibility to help build institutions and all that. But where it is generally not very practicable, such directive will rather lead to the negative impact on the development of the country than positive.
You mentioned that there was no prior engagement with the business community before this was enforced. Would you like the opportunity, or is there are you trying to reach out to the Ministry of Finance or maybe the National Insurance Commission to get them to discuss possible exemptions or adjustments?
Well, I think that as a matter of fact, they've heard we are ready for them. They came out with their policy, and the policy is supposed to be applied by us, and they are supposed to invite us. Why they did not invite us, I don't understand. We are the people to implement the thing. These are our businesses, and it's a free market. We determine where we want to put our place risks on. So they don't just come in and give a sweeping directive that ensure locally. When you don't even locally, when the government doesn't own the goods, the insurance people don't own, they are doing their business. And so if they are very strong and good, we will as much be able to convince our suppliers to do business with them. But it doesn't have to take a directive. It doesn't have to take an enforcement. It doesn't have to take power to do that in a free market where the forces of demand and supply determine that. And in this case, it's not even largely demand and supply. It is largely the fact that the goods don't belong to the local person. And that's why I've broken it down to the simplest term that go take a loan from a bank and buy a vehicle and see whether you have the right to determine where you can insure that vehicle and what you can do with that vehicle. That vehicle, even though you are the one driving it, it is largely controlled by the bank or the lender for that matter. It's the same thing that happens to the goods that we bring into this country. Oh. You don't have absolute control over it.
Right, and I believe this is being introduced to provide some safeguards or buffers. So I'm saying that going forward, in terms of solutions, what would you recommend so that the policy protects businesses and not also cause excessive burdens on
we recommend
business
for
community?
now. We recommend for now the government should suspend it and then invite us to a meeting. We are very, very open to discuss this thing dispassionately, and we are open to the fact that we are all interested to help build the local economy. We are not at variance with the vision of the finance minister. We are with them, but this particular one, we were not consulted, not just because we were not consulted, but the directive, it will be so difficult to be implemented. It goes into the domain where we do have much more control as local importers.
All right. Thank you so much for your time. Chairman of the Food and Beverages Association, John Awuni there. I appreciate your time on the marketplace. We're taking a short break. When we come back, we'll talk about the financial markets. We've got our eyes on the Treasury bill auction, where there was the Treasury bills continue to reach record highs. We'll talk to you about that after this break. Don't go anywhere. And welcome back. Investor interest in government treasuries continue to reach record highs as total base tendered exceeded the target by over 144%. That's according to auction results by the Bank of Ghana. Meanwhile, interest rates tumbled across the yield curve. Mark Jordan Sikanate is Senior Associate Research at Lawrence Africa Securities. He joins me on Zoom. So last week's Treasury bill auction was oversubscribed by 144%. What is your reading of this strong demand?
Thank you for having me. Yes, so like you mentioned last week, we saw an oversubscription in government treasury bill auction. I think it's about the 10th in a row. And if you check the trend, which also explains why we are seeing the robust demand on treasury bill. You recall that prior to the MPC sitting in November 2025, government was recording, significant under-subscriptions and also missing targets in most of its treasury bill auction. And one of the reasons we were stating from our side was the fact that other money market securities like the OMO bills were presenting quite, impressive opportunities to investors. That's why we're seeing funds channeled towards those sides. I think the narrative has changed since then. In the past 10 weeks, we've had like 2 MPC sittings. Monetary policy rate has cumulatively declined by about 600 basis points from 21% as of November to 15%, 15.5% as of now. Now, with these dynamics in play, we've also seen considerable decline on interest rates on the OMO bills, which is sold by the B. And as such, we are seeing a cautious play by investment, shifting capital from those other money market funds into the treasury bills. And particularly, even with the treasury bills, when you check, you realize that they are still around the 10 years with high rates, and that is the 364 day bill, which continue to attract over 40% of investor demand.
As we've seen yields on the T-bill curve fall sharply, what should investors expect in the coming weeks?
Okay. So what we expect what we think investor positioning should be in the coming week is a cautious bidding dynamics. One, because liquidity levels are high in the market, and then from the treasury perspective, they kind of have an ample hand going into auctions. Two is also the fact that their demand is beginning to slow. Remember, we mentioned that we see considerable maturities in Q1. They are beginning to have high liquidity levels to back this liquidity demand from their side. And also, lastly, is about the fact that we just saw a 250 bips decline on monetary policy rates to 15.5%. And currently, OMO bills are around 11.5% as per results shown in the last OMO bill auction last week. This places treasury bill securities favorably above these OMO bills, especially the 364-day bill. And so investors, we encourage that investors, we caution that investors, bid consciously when they are going into treasury bill auctions, because when you watch from the past 2 auctions, last 2 weeks, government rejected over 3 billion. Last week, it rejected slightly over 4 billion. That tells you that gradually it is strengthening its grip, and then it's going to take advantage of the 50 basis points in OMO yield to also trim its borrowing cost. Yeah.
And I guess with the interest rates tumbling, we're beginning to see the effects of the policy rate cut, right?
Yes, we are beginning to see it. 37 bips drop on the 91-day, and 28 for the 182, and then 24 for the 364, all in last week's, just in a single auction. Also, when you check from the auction, you saw that the higher band of interest rates also declined considerably. we expect the narrative to continue going into the coming weeks, and it could even be more louder because we expect liquidity levels to continue to shore up. Remember, government will be heading into coupon payment of over 6 billion in the month of February. We are not far from this payment date. So it could see ample, increase in liquidity levels in the market, and then opportunities are quite, skewed towards the short end, especially the treasury bill side still. So these funds will still be flowing towards those end of the market. So with all these factors at play, we will likely see the impact of the 250 basis drop in monetary policy rate in government's borrowing cost as well.
Yeah, and so with the upcoming treasury bill auction, we understand there's a reduced offer target. So what strategies would you recommend for investors who are seeking to navigate the primary and secondary markets in the near term?
I think, like I've been mentioning, right, with the reduced target and also elevated liquidity levels in the market, it clearly points out to the fact that the narrative favorably, the narrative actually favors the treasury, with slightly around 5 billion targets, with also liquidity levels coming considerably above like 10 billion for some weeks now. You can tell that these liquidity levels can easily absorb government target, and as such, you want to position yourself consciously as an investor when you are bidding, so that your bids are not rejected in this auction. Otherwise, when they are rejected, you find yourself going to search in the secondary market, and also that comes at another punitive price.
Yeah, let's switch topics. Let's talk about the stock market. Yet another week of a strong finish. Talk to us about that and what we expect this week.
Yeah, so it was a great week last week for investors on the equities market. We saw considerable rebound in Cowbank. I think notably the stock has taken the lead in the double-digit year-to-date gain with over 25% year-to-date gain. We've seen increasing bidding activity around the counter. I think for our outlook for this week, we expect the stock to climb further in sessions in this week. We're also seeing considerable bidding activity around stocks like MTN and also GCB, which could suggest some increase in price in the course of the week. I think we also see some activity around EGL, and I think it's situated around the conversations we were having with your earlier guest, which could have some improvement to the earning prospects of insurance counters. So we're seeing some activity around Enterprise Group as well, which could be positive for price in the coming sessions.
All right, thanks for the update. Very useful. Mark Jordan Skanate, Senior Associate Research at Lawrence Africa Securities. Thank you. Well, prices of petroleum products are set to increase significantly today, according to industry data that guides fuel price adjustments for the next 2 weeks. More in this report.
Based on the data, petrol is likely to be increased by up to 2% per litre and could be sold at 11 Ghana cedis 48 pesos, up from the current price of about 10 Ghana cedis per litre. Diesel, on the other hand, is projected to witness one of the highest increase, going up by more than 5% per litre. However, LPG will witness just under 1% hike per kilogram. The Chamber of Oil Marketing Companies has indicated that based on the current market conditions, it is likely that most of the oil marketing companies will keep prices unchanged. However, majority of the oil marketing companies that we have engaged have told Joy Business that they will not rush to increase their prices from today, but will be monitoring movements by some of the market leaders before they react. There are currently more than 200 oil marketing companies in Ghana. Prices are going up on the local market due to the city's depreciation against the dollar over the past weeks and rising prices on the international market.
Meanwhile, some oil marketing companies have already begun increasing prices at the pump. Star Oil and Goil have marginally raised the price of petrol to 9 cedis 99 pesos per litre. However, Star Oil has maintained the price of diesel at 10 cedis 97 pesos, while Goil has increased diesel to 11 cedis 90 pesos per litre. Other major oil marketing companies, including Zen Petroleum, have also adjusted prices at the pumps. In a related development, the National Petroleum Authority has raised a fuel price floor for the next 2 weeks. According to data cited by Joy Business, petrol should not be sold below 9 cedis 99 pesos per litre, while diesel should not be sold below 10 cedis 95 pesos. This move is expected to compel more oil marketing companies to increase prices, as no firm is permitted to sell below the approved price floor. All right, and that's it for the marketplace. More news on our website, myjoyonline.com/business. We've got the day's latest stories from over there. We leave you with our Money Lab episode for today.
Hi there, welcome to Money Lab. My name is Paul Kofi Manti. I work with the EcoBank Group. We have been discussing personal finance, and today I want to bring your attention to one important area of financial planning, that is retirement. This is an area you need to pay attention to. I asked an important question. Have you seen somebody who is on retirement who is struggling? If you have probably seen one, but remember, this person was at a point in time working just like you. If you don't pay attention to this area, what you are seeing in the life of that person, you can see same in your life during your old age. The last time I checked, there are over 2 million Ghanaians who are over 60 years. Only 300,000 or less are on a state pension, and the few privileged who are on state pension are getting monthly pension of less than 5,000 Ghana cedis. You are already at the crossroads. Will you create a retirement that you want, or you take that one that shows up? If you don't create a retirement you want, you will not like what shows up. Remember, financial independence is possible. Many thanks for making time for Money Lab.